I think where I myself and most people, I think, especially in today's financial climate of living paycheck to paycheck, the thought of having to switch all that money into your life insurance and wait a few years in order to get a car, I feel like that seems unattainable for a lot of people, perhaps. So what is, the solution for those individuals? I might find myself, in that tricky balance of trying to transition myself to paying more premium, to capitalizing my own system, to putting my own money through that system, but find myself stumbling over the roadblocks of, I got all my bills due at the end of this month. How do we transition ourselves into a more control and owning of our finances?
Welcome to the Bankless by Design Podcast, where we rethink money, ditch the system, and rediscover what it means to truly thrive well. I'm Tricia Miller, mom of 7, financial coach, and founder of ThriveWell. Around here, we believe wealth is more than numbers. It's about freedom, stewardship, and building a legacy that lasts. If you're ready to challenge the norm and take back control of your financial life, you're in the right place. Welcome to the Bankless by Design Podcast. I'm your host, Tricia Miller, and I'm here with my son, Jonathan, today, and we're going to be working through pages 23 and 24 of the 5th edition of Becoming Your Own Banker. And this is where Nelson starts taking us into a deeper mindset shift from thinking only about death benefit to understanding the lifelong need for financing, capitalization, and building a system that can not only serve you, but generations after you. But before we get started, Jonathan, how have you been? And inquiring minds want to know, where have you been for the past few weeks?
I'm doing well. I'm glad to be back. Thanks for having me back on. Yeah, just, busy with the day job life. And then my side hustle, Miller's Bricks, has had quite a lot going on lately that's kept me very occupied. I've had 2 very awesome opportunities come up where I've been selling some other big Lego collectors collections on commission for them. And we actually have our biggest ever show coming up this Saturday. It might end up being a 24-hour show, so we'll see.
Wow. I saw pictures of how much Lego you have to sell, and that's incredible. And sometimes I feel like if we weren't doing this podcast together, I might not get to speak to you very often. Anyways, I'm glad to have you back today. While you've been gone, I have tackled this chapter without you. And just to kind of recap, we've looked at long-range conservative behavior of the life insurance company. We've learned a little bit about the assumptions that are made in an illustration. We've learned a lot about the dividend, how dividends are distributed, but also what a dividend is, and just how powerful a dividend can be. But one of the things that I just wanted to recap before we jump into the next section, Nelson had mentioned how these dividends can get pretty significant over a long period of time. And he said that he bought a policy from a major insurance company back in 1959, and that the annual dividend is, as of the writing of this book, that the dividend was actually over 10 times the annual premium now. So I got to thinking about that. He actually has a picture in his other book, Building Your Warehouse of Wealth, of his dividend checks. And now you're not going to really be able to see this on here, but for anybody that's interested, it's on page 21 in this book. But the important point is that he was paying a premium in 1959, a level premium of $388 per year. Now, the policy has been in force for 52 years. Okay, so again, thinking long term, he was now receiving dividends in 2009 of $4,015.55. That's just the dividend from a $388 premium. So that's well over 10 times the premium in a dividend. That's not including the increase of his cash values. So you can see just how powerful that dividend can become and how that creates that exponential curve that we are all really looking for. I'll grant you 52 years down the road, but guess what? Those years come. I may not see 52 years down the road. Fortunately for Nelson, he had policies from when he was quite young. You, Jonathan, however, you're going to have that opportunity What a great opportunity you have in
Hope
front
I
of
see
you.
it even past 50 if I get a little longer than that.
Exactly. That's what I mean. You'll actually be able to enjoy that 50 years down the road. So then we're going to get into this next section. So I just really wanted to bring that up because he's actually got the numbers right there in another book. And the next section starts, so far, this is pretty simple stuff. Now for the complicated part. So I'm really glad you're back, Jonathan, because apparently I was able to deal with the simple stuff, which I just kind of laugh at because when I was preparing for this section of the text, I was like, there is so much more in here. And I really did have some studying to do. So I'm glad Nelson thinks that that's the simple stuff. So if that's the simple stuff, what are we in for? Okay. So would you like to start reading that?
All right, so we're getting started about halfway down on the right-hand column of page 23.
Right.
So far, this is pretty simple stuff. Now for the complicated part. The life insurance salesperson calls on my all-American young man, referred to earlier in this book, the one that was making about $28,500 after taxes and is 29 years old, and urges him to consider how much the world is going to miss you in the case of your untimely death. So he calculates his human life value by asking how much he expects to earn per year as an average and multiplies that by the number of years that he expects to work, assuming he lives that long. Assuming that he will get pay raises from time to time, it is reasonable that his average annual income to be something like 38,000 times 36 years until his age 65, which will produce about $1.368 million in income. The insurance agent points out that he will use up something like 40% of this income stream to support his own needs. This means that $820,800 in income for his family and the charities that he holds dear will vanish if he happens to die in the near future. To arrive at a principal sum, the capital that would be required to produce that income stream, this figure must be discounted at a normal rate of interest. The agent says, so if we were to have to buy a machine that would produce that income to your family, we would have to pay about $400,000 cash for that machine. Now, that's how valuable you are to them and your charities. Mr. Doe, if you owned such a machine and it was subject to sudden loss of some kind, would you insure it? Mr. Doe says. By all means, the agent asks, how much would you insure it for? Why, $400,000, of course. To which the agent responds, now that we have that established, let me show you how little you will have to pay my company to satisfy that need.
Okay, let's stop there. So he's touched on a few things. One is this idea of human life value. So let's talk about that just for a second. What is someone's human life value? When it comes to our loved ones, we think of them as priceless, right? There's no amount of money that can replace an individual. But when it comes to life insurance, it is based on a financial loss that a family would experience should you lose a loved one. So if I am married and my spouse dies, then all of that spouse's future earnings are now lost. So that is what the life insurance company is looking at is, okay, how many more working years typically does this individual have? How much money are they making? So now I'm going to take that gross salary and I'm going to multiply it times an income factor. And that amount of money would be the human life value. So a couple things about that. First, that means that there is a value there to be insured. And that's a very real value. There's an incredible risk of loss, financial loss, when we lose someone in our family, even if they're not the breadwinner. So I say that we typically think of it as the breadwinner, but what about the spouse who is maybe caring for the home, maybe not a working spouse, but there may be children that need to be cared for, or all of the other things that person, that spouse's labor would have to be replaced by someone else, not to mention we need time to grieve. We might need to go see a counselor. We might need a vacation. We're not just going to go back to work tomorrow if our spouse dies. This can take some time to recover and return to any kind of normalcy. And during that time, we might not be working like we normally would. So there's all of this financial loss to account for. So people don't think about the importance of insuring their own lives. We insure the car, we insure the house. Those are valuable things, but what's more valuable than the people in our lives? So He's comparing it to this machine that's earning you money. Well, of course, how much would you then insure that for? And what did he say here?
Only
Basically.
400,000, yeah.
Yeah, he says only 400,000 because he said the machine would cost that much. So he's really just ensuring that cash coming from that machine, if I've got that correct.
Yeah, because it mentions that it would be $820,000 or so that his family would be missing out on, but the machine to create that much value would cost about half that. So interesting that he chooses to insure the value of the machine rather than actually the value of what, is needed.
Right. So it's really not even the full amount that this person should be insuring. Because in my book, that person actually was going to produce $1,368,000. And that is actually what should be insured. This hypothetical salesperson that Nelson is talking about, I believe, is selling a term policy. Well, I can't say that for sure. However, the important thing that he says is how little you'll have to pay my company for that death benefit, because term is cheap, right?
It seems like the, perspective or the mindset I think that Nelson is trying to emphasize here is that it's paying the least amount possible to just make sure you got some life insurance. It's not even like, oh, hey, make sure you have enough life insurance. It's how little can we pay here to make sure you're covered at least,
Yes, he's entirely going after the mindset here, without a doubt. I'm trying to pull a little something else out of here for people to recognize their actual human life value and the fact that they should insure for it. Because just take, for example, my own best friend, whose father passed away at 52. He was the breadwinner. Mama had a high school education. She had to go to work the best she could. She didn't have the earning power, but he had very little insurance on him. Well, 52, that's young. She has lived now at least 23 more years since he's passed away without any of that income that he would have produced. Well, that has created a tremendous burden on the rest of the family. So we really do need to think this through, that there is a financial risk that we're setting at. And what a shame. You've already are grieving the loss of a human being that you love dearly. But now you also are now living out maybe the next 20 to 30 or 40 years of your life, not only grieving without them emotionally, but now you're struggling financially. So we should be looking at what is that human life value. But back to the mindset issue, because this is totally key as to what he's getting at here. The typical thought is, how little can I pay for just enough death benefit to maybe mitigate this situation a little bit? Very few people actually insure themselves up to their human life value. I'm working on getting there, but that is rare. I would bet even individuals at the life insurance home office are not insured to the human life value. Actually had James, he said this to me the other day. He said, Tricia, you probably are paying more premium for more life insurance than even the president of the company. And I was like, I hadn't thought about that. But
a little addicted to premium there, Mom.
He could be right. I might be.
Well, hey, what does Nelson say? When you understand what's going on, you know what to do.
Exactly. So the mindset shift is about to hit here with the very next paragraph, I believe, because he's going to talk about, instead of a little bit of premium for death benefit, to recognizing our need for finance. So let's just see where we go with this next paragraph, if you don't mind reading it.
My word. If you will take an honest look at what this young man is now doing, paying over 35% of every dollar of after-tax income to interest alone, it should be obvious that his need for finance is much greater than his need for life insurance protection. If he would solve for the need for finance through dividend-paying life insurance, he would automatically have much more life insurance and recover all the interest he is now paying to someone else. But this almost never occurs because of the mental block implanted by financial geniuses that life insurance is a poor place to store money. What a limited outlook of just what is going on in the banking world. Again, I remind you, if you know what's really happening, you'll know what to do.
Okay.
Guess I caught that a little early.
Yes, you did. You did. So key point here, we're going back to our original young man in the chapter on the problem, or what is he, 29 years old, 28 years old, where we talked about the problem of interest, that he's already paying 35 cents of every dollar to interest. Therefore, his need for finance is greater than his need for life insurance protection. Even as I just said, your need for life insurance protection is tremendous. Nelson wasn't saying you don't need life insurance protection. In fact, some people will claim that because he says this, that he's somehow diminishing the need for a death benefit. But that's not really true, because what he's saying is if you solve for this, the need for financing, you'll have all the death benefits you could possibly want. Thus, your mom is addicted to premium and has a substantial death benefit. Okay. That's because premium is the solution. All right. I think we actually need to go a little bit further to get to some of the point.
Okay. Yeah. I can go back to that. And so the young man puts $50 per month into life insurance premiums and feels that he is insurance poor. He is worth more dead than alive, etc. And then he goes down to a dealer and buys an automobile, paying for it with a loan from a bank or a finance company. Remember that there is only one pool of money out there in the world. The fact that any number of organizations or individuals are managing a portion of the pool is incidental. But it can be even more specific when it comes to automobile loans. I have never seen a monthly list of investments from a dozen major life insurance companies that did not include finance companies as a place where they have loaned blocks of money. The finance company simply buys blocks of money, adds a fee to it, and loans it to consumers that buy cars. So this man pays $260 per month for a minimum of 48 months for his $10,550 car loan. He does this throughout life because that's the way all his peers are doing it. If he would take time out and stand back far enough to get some perspective, he might notice that he is paying $50 per month into a pool of money, the life insurance policy, and paying $260 per month to an intermediary, the finance company that deducts a fee and lives well off the activity, which passes the residual sum back to the same pool of money. Furthermore, he complains about the premium he pays but thinks nothing of the much larger amount he pays the automobile finance company. Strange, isn't it? In the above example, he is paying a total of $310 to the pool, $50 directly and $260 indirectly. If he could muster up the courage to pay the $310 directly to the life insurance company in the form of premiums for around 4 years, he could now make a policy loan and pay cash for the automobile. Here comes the important part again.
Okay, let's stop there. So you get the picture, right? You've got one pool of money. He's complaining about the $50 for the insurance. And I think in large part, that's because when we pay for insurance, we're paying for something kind of intangible, especially if we're paying just for a death benefit that we're never going to see ourselves. So we think, it just feels like money I've just got to pay. And it always is going to feel like too much money. At least when you pay $260 per month, he gets to drive an automobile and actually see physically what he's spending money on. Mm-hmm. But the idea here is that regardless, the total of $310 is going back essentially to the life insurance company. He just doesn't know it because it's going to the dealership who stands in the middle between him and the life insurance company who gave the dealership the money in the first place. Mm-hmm. So it's all about your perspective. Obviously, he says if he stands back far enough and realizes what's going on, and there's that line again, if you know what's really happening, you'll know what to do. You could kick that middleman out of the way. You could become the middleman. I'll never forget, my dad always said, McDonald's is not in the hamburger business. They're in the real estate business. Well, in another sense, a car dealer is not in the car business. A car dealer
finance business,
is in the finance business. So Nelson's just saying, you need to get into the finance business for yourself because that's where all the money is. Banking is the most profitable business in the world. We should be in two businesses, our own business and the banking business. The car dealership is making all of the interest off of you when you could be making all of that interest and recapturing that back into a system that you own and control and making a profit off of your own financing if you could just simply realize that you could become your own banker and put on your own banking hat. So you're still the consumer, but now you can also be the banker. Do you have any other thoughts on that, Jonathan?
Yeah, I think when I was reading this initially, I was struggling to articulate my thoughts on it a little bit, but I think where I myself and most people, I think, especially in just today's financial climate of living very paycheck to paycheck, the thought of having to switch all that money into your life insurance and wait a few years in order to get a car, I feel like that seems unattainable for a lot of people, perhaps. So what is, the solution for those individuals? Or, I mean, because I've myself find myself, in that tricky balance of trying to transition myself to paying more premium, to capitalizing my own system, to putting my own money through that system, but find myself stumbling over the roadblocks of, I got all my bills due at the end of this month. I obviously, like he says, it takes some courage. It takes a mindset shift. Maybe it takes some sacrifices on my end of, where am I spending my money, etc. But yeah, that was just something that kind of crossed my mind, right? Is how do we transition ourselves into a more controlled and owning of our finances, I guess, if that's the best way to say that.
Yeah. I guess Parkinson's law comes to mind first thing, right?
Yep, absolutely.
We do have to live below our means. So yes, it's going to take some sacrifices. It's going to take some discipline. It's going to take some time to capitalize a system, which is really no different than saying it's good old fashioned savings. And in order to do that, you've got to have discipline. This is not a get rich quick. This is a get rich slow. But if we know the goal and we have the commitment, and honestly, you actually can start banking sooner than waiting 3 or 4 years. Now, you might not be able to turn around and buy a car tomorrow with your policy. I mean, we all start somewhere. But even if we start small and we just do a little bit at a time, just consistent, disciplined steps is better than not starting. It will eventually get there. I think of some of the basic financial wisdom that is taught also in The Richest Man in Babylon.
I was about to say, it's so funny you said that.
I just love that text. I do. I mean, it's just such solid wisdom because if your chickens lay 10 eggs, set one aside. I can't remember if that's the example or not, but it's this idea of 1/10 of whatever you bring in. Learn to live on 90% of it. You will be amazed when you set that goal that you will find ways to make that goal happen. And that may be where we just need to start, is just the simple, every time I bring in $1, I'm putting 10 cents aside. And eventually that is going to stack up over time because time is going to go by and that pot is going to grow. And then for somebody who's just starting out, they might not even have 2 nickels to rub together to start a policy to get this thing going. It might take a year of just consistent learning to live below their means, getting some things under control, getting some good habits and some discipline, and setting that 10 cents aside every single time you get paid until you have, a little nest egg savings account that you can even begin a policy with. And then it's going to take a few years to capitalize that perhaps further. So there's no get rich quick thing here. But if you can get past that hump, shall we say, the rest is gravy because long term, this just takes off. So keep your eye on the prize, long range thinking in order to get yourself to that place. I know it's tough today. It is. There's no doubt about it. There's absolutely no doubt about it. And I feel for young people like yourself who are living in an incredibly inflationary situation. And yet, I'll bet you know of places that you could change your living circumstance, that you could change your own financial habits and make it happen more. I know you're working very hard on your side hustle, and you're probably using most of the profits from that to pay a premium to then take over some debts, right? Would I be right about that?
Yeah, absolutely.
So you're working your tail off to earn more money. And sometimes generating more income can be more substantial than just cutting out the extra cup of coffee at Starbucks. But we could also cut out this cup of coffee at Starbucks for a little while if we need to, right? Or we could take in a roommate to help pay the rent. And that might be more substantial. There's lots of things that we can do if we really want it bad enough. There's got to be the desire there. I don't know if that helps.
No, I think it does. Thanks.
Okay, so I think this is a good place for us to pause today. So far, we have talked about our human life value, the importance of protecting the people that we love, and why our need for finance is far greater than our need for death benefit alone. But here's a beautiful thing. When we solve for our need for finance through a properly designed, dividend-paying whole life insurance contract, we can also end up with far more death benefit than we ever would have thought possible. We also took a step back to see how there really is only one pool of money. When our young man in the example today is paying $50 for insurance and $260 for a car loan, he may not even realize that he is paying an intermediary, the dealer or the finance company who obtained the money from the insurance company in the first place and is making good money off of that financing transaction. Well, Nelson said if the young man could get up the courage to pay the entire $310 directly to the life insurance company and begin capitalizing his own system, he could eventually finance his own car and make the money the finance company would have made off of him instead. Well, then Jonathan asked the practical question, how does someone actually transition from paying banks and finance companies to becoming your own banker, especially if you're living paycheck to paycheck? And the answer is with courage, discipline, and dedication. We have to learn to live beneath our means, create margin, and begin steady capitalization. In the beginning, that may look like old-fashioned savings, simply setting aside a portion of what comes in until we are in a position to begin taking that financing function back over, bit by bit. It's not an overnight process. Nelson said it takes courage, so let me encourage you to be courageous. And if you want help thinking through your specific situation, that is exactly what I'm here for. I am here to coach you and help you build a personalized strategy, whether you're young and just getting started, or you've been around the block for a while and you're ready to handle your money with more intention. Please feel free to reach out to me at banklessbydesign.com. Now, in the next episode, Jonathan and I are going to pick up right where we left off and talk about what it actually means to pay yourself back with interest, why that matters, and how this begins to grow a system, not just one policy, but a private banking system that can serve your family for generations. Thank you so much for joining us today on the Bankless by Design podcast. And if this episode has given you something to think about, would you share it with someone you care about? And if you have not already, please be sure to subscribe so you can join us for part 2. Until next time, have a great week, and thank you so much for listening. Thanks for tuning in to the Bankless by Design podcast, where we're done with the system and we're doing money differently. Be sure to subscribe, share this episode with someone who needs it, and visit us at banklessbydesign.com to learn how you can start living bankless by design.